Real people, real money, shocking truth. In October 2011, a group of investors bought shares of a brand new ETF at $8.47 per share. The dividend that year was 22 cents per share, a modest 2.6% yield, nothing remarkable. Fast forward to May 2026. Those same shares, never sold, dividends reinvested, now pay $1.055 per share annually. That is a yield on cost of 12.5% on the original investment, not because the yield changed, because the dividend grew every single year for 14 consecutive years. This is the story of SCHD, the Schwab U.S. Dividend Equity ETF. $91 billion in assets, 481% cumulative return since inception, and right now in 2026, the best performing U.S. dividend ETF year to date. Most investors have never heard of it. Today, that changes. In the next 8 minutes, 3 things. First, what makes SCHD structurally different from every other dividend ETF, and specifically what it refuses to own that makes it unique? Second, the 2026 Reconstitution, the annual rebuild that just happened in March, the 25 new stocks added, the 22 removed, and why the smart money is paying close attention. Third, the yield on cost math, the compounding mechanism that turns a 3.3% yield today into a 12% yield on your original investment by 2040. What SCHD actually is. The foundation, precise and authoritative. SCHD tracks the Dow Jones U.S. Dividend 100 Index. Every year in March, it rebuilds itself from scratch, screening a broad universe of stocks against 4 non-negotiable criteria. 10 consecutive years of dividend payments, minimum. Strong cash flow relative to total debt, high return on equity, and a healthy 5-year dividend growth rate. Companies that no longer meet all 4 criteria get removed. The highest-ranked new qualifiers get added. The result is a portfolio of exactly 100 companies, not 500, not 3,500, 100. The most elite dividend payers in the United States as determined by the most rigorous quality screen in the ETF universe. What SCHD refuses to own. The insight that sets it apart. Here is what most investors miss about SCHD, and it is more important than what it owns. SCHD holds 0 Apple, 0 Microsoft, 0 Broadcom, 0 Nvidia, 0 utilities, 0 REITs. Not because these are bad companies, because they do not pass the cash flow, dividend history, and growth rate screens simultaneously. VIG and DGRO, 2 popular dividend ETFs, hold massive positions in Apple, Microsoft, and Broadcom. This makes them behave like growth funds in a tech bull market and like dividend funds when tech sells off. SCHD does not play that game. Its top holdings in May 2026 are Texas Instruments, Qualcomm, United Health Group, Chevron, PepsiCo, and Coca-Cola, companies that generate cash regardless of whether the Nasdaq is up or down. That structural independence from tech is exactly why SCHD outperforms when markets rotate away from growth, like it has in 2026. The 2026 Reconstitution, the news nobody covered. Breaking information drives shares. In March 2026, SCHD completed its annual reconstitution. 22 stocks were removed, 25 new ones were added. This is the most significant portfolio event of the year for SCHD holders, and almost no one in the mainstream financial media covered it properly. Here is what actually changed. Energy exposure dropped from 23.5%, its highest ever weighting, to 16.3%. Consumer staples rose to become the fund's largest sector at 19.4%. The most significant additions: Procter & Gamble, 64 consecutive years of dividend increases. United Health Group, healthcare exposure at scale. Qualcomm and Accenture, technology with actual dividend credentials. The biggest removals: AbbVie, Cisco Systems, Halliburton, and Valero Energy, all quality companies that no longer ranked in the top 100. The reconstitution is not random. It is a systematic quality upgrade that forces SCHD to buy low. Incoming stocks enter because they have compressed valuation and improving fundamentals, and sell high. Outgoing stocks leave because they have become expensive relative to their dividend quality. This mechanical discipline is what compounds into 12.5% yield on cost over 14 years. Here is the signal that serious investors track. Over the past 3 years, SCHD was one of the worst performing dividend ETFs. The AI and tech-driven rally made everything SCHD owned look boring. And during those 3 years of underperformance, investors poured over $25 billion of net new money into SCHD. $25 billion of patient capital buying an underperforming fund. That is not retail investors chasing performance. That is institutional and sophisticated investors who understand what SCHD is built to do. And in 2026, as markets rotated hard away from mega-cap tech, as volatility returned, as defensive value stocks outperformed, every one of those patient investors is being rewarded. SCHD is the best-performing U.S. dividend ETF year-to-date in 2026. The smart money saw it coming. Now you know why. The yield on cost math, the compounding secret. Let me show you the math that changes how you think about dividend investing permanently. This is called yield on cost. You buy SCHD today at a 3.3% dividend yield. The dividend grows at its historical average of approximately 11% per year. In year 5, your yield on cost is 5.5%. In year 10, 9.4%. In year 14, as early investors just experienced, 12.5%. You are not earning 12.5% because the yield went up. You are earning it because the income grew while your original investment stayed fixed. The investor who bought $10,000 of SCHD in 2011 is now collecting $1,250 per year in dividends from an original investment of $10,000. That is the compounding mechanism that makes dividend growth investing so powerful over time, and it is completely invisible to investors who focus only on current yield. The downside protection story. The risk-adjusted case. Here is what most SCHD coverage misses entirely. The return is only half the story. The risk is the other half. In 2022, when the S&P 500 fell 18% and growth ETFs fell 30%, SCHD fell approximately 3%. In the 2026 tariff-driven volatility that rattled markets earlier this year, SCHD's drawdown was roughly half that of the S&P 500. This is not luck. This is structure. Consumer staples, healthcare, and energy companies, the core of SCHD, generate cash flow regardless of economic conditions. People buy Coca-Cola, PepsiCo, and Procter & Gamble during recessions. They need Merck and United Health coverage when times are bad. And SCHD's forward PE of 14 is 35% cheaper than the S&P 500's 22 multiple. You are getting superior income, lower volatility, and better value simultaneously. That combination is why $91 billion of investor capital is parked here. Here's how to own SCHD starting today. Step 1. Open a brokerage account at Fidelity or Schwab. The link is in the description. Schwab is the natural home for CHD, given that Schwab manages the fund. Zero commission trades, fractional shares, no account minimum. Step 2. Buy SCHD. At approximately $31.75 per share as of May 2026, fractional shares available at Fidelity for smaller accounts. Step 3. Immediately set up dividend reinvestment. In Fidelity, accounts to positions, TSCHD to reinvest dividends. In Schwab, account services, dividend reinvestment. One click. This is the setting that compounds your 3.3% yield toward 12.5% over time. Step 4. Set up automatic monthly purchases. Even $100 per month. The systematic buying discipline is what smooths volatility and builds positions over time. Step 5. Do not touch it for 10 years. That is the entire strategy. Here is the insight that ties everything we have covered on this channel together. SCHD inside a Roth IRA is the most powerful combination in everyday investing. Every dividend SCHD pays, currently $1.055 per share annually, is completely tax-free inside a Roth IRA. Every point of price appreciation, tax-free. Every compounded dividend reinvestment, tax-free. The yield on cost that early investors earned 12.5%, would have been reduced by your marginal tax rate if held in a taxable account. Inside a Roth IRA, it compounds entirely intact. A $7,500 annual Roth IRA contribution invested entirely in SCHD over 20 years at historical returns generates a portfolio worth over $500,000, paying approximately $16,500 per year in completely tax-free dividends. We covered the Roth IRA in detail in Video 5. If you have not opened one yet, that video is the place to start. The 3 mistakes. Loss framing. Highest shares. 3 mistakes that cost SCHD investors returns. Mistake 1. Taking dividends as cash instead of reinvesting. Every quarterly dividend taken as cash is compounding that stops. The entire yield on cost story depends on reinvestment. Turn on drip immediately. Mistake 2. Selling during underperformance. SCHD underperformed for 3 years from 2023 to 2025. The investors who sold missed 2026's recovery. The investors who kept buying or who added during the underperformance are now sitting on some of the best entry points in SCHD's history. Mistake 3. Owning SCHD in a taxable account when a Roth IRA is available. Dividends in a taxable account are taxed as ordinary income or qualified dividends depending on your bracket. In a Roth IRA, zero tax ever. The account location matters as much as the ETF itself. SCHD has paid a growing dividend every single quarter since October 2011. Through the 2015 oil crash, through the 2018 rate hike cycle, through the 2020 pandemic, through the 2022 bear market, through the 2025 AI bubble, it never cut, it never stopped, it grew. Drop the word compounding in the comments if you own SCHD or if today's video convinced you to start. I read every single one, and if this video taught you something you did not know, hit like. It helps more people find this channel. Next Tuesday, I am covering the year-end tax moves that can save you thousands of dollars, moves that have a hard deadline of December 31st and that most people miss completely. Subscribe and do not miss it. See you Tuesday.